Okay, so we left that. Thank you, Sally. And our next presenter is Erik van Deventer.
Hi. So I'm Erik van Deventer. The strong dollar and the political economy of financialization is my doctoral thesis, which is not published yet, so you can't buy it. But what it looks at, it's specifically about the US economy, but as part of the world economy, the connections between these things. And this is because most of the research that is done on the topic of financialization is rooted in the US economy, and that is to its detriment. And also, it completely ignores things like Luxemburg's work and value theory, which I wanted to actually discuss and include. So topics such as financialization, the increasing share of the profits in the US economy that are going to the financial sector, insurance, real estate, rent, and so forth. The issue of neoliberalism, the quoted rise in power of the capitalist class, and seemingly a transformation of our economic activities towards kinds of rent-seeking and rentier capitalists, capitalists who are trying to make super profits, excess profits, without necessarily producing things that contribute to economic well-being for most of us. And the transformation of the capitalists and the upper middle classes even towards trying to get wealth through capital gains and playing in the property markets and the stock markets, essentially taking not so much the value of production, but a fictitious value that is created by the acceleration and inflation of asset prices, which is largely boosted by state policy. So I wanted to look back at the roots of the state policy and how it came to be that an economy such as the US should turn so sharply away from growth through manufacturing and employment to something like this financialization that we've seen. And there's a trade-off here, right, between the development of the manufacturing industries and finance. And we've seen increasingly that finance has, and other non-manufacturing or non-quote productive sectors have seen the benefit of this. In fact, in many cases, there's been disinvestment by the productive sectors. So manufacturing has deindustrialized to a great extent, but some of these firms will actually take not only all of their operating surplus and hand that over to shareholders in the form of stock buybacks, but they'll take more than that. So they'll effectively hollow out and disinvest from their manufacturing industries. So I wanted to look at how this may have happened and what the state's role in it was. And so I'll provide a little bit of historical background there with my time. So during the 70s, the US was working with certainly the largest and one of the more advanced industrial sort of bases of the world economy, very large, coming out of World War II and the investments that happened after that. But it was getting old, and more advanced industries were being built in places like Japan and in Western Europe. And the US was seeing a falling rate of profit, these capitalist firms, and were given a choice between a massive round of investment to replace and overtake the existing kind of industrial base of US society, or to do something different. And at the end of the 70s, they sort of collectively made a decision not to make those investments, but instead to look for other opportunities. Now, what we've seen since then is that those opportunities were found in financial investments and globalization and international kinds of investment. But it wasn't obvious at the outset that this would be possible because the returns on financial investments at the end of the 70s were quite low. Inflation was very high, almost up to the rate of interest. So financial sector was not doing very well. And the result of that was that the US was actually experiencing, or on the verge of at least, capital flight. So the US was not consistently getting inflows of capital from the rest of the world, and the value of the dollar was deteriorating. So the capitalists, during the Carter administration, you may have heard of the Volcker shock, the actions taken by the Federal Reserve, actions taken at the outset of the Reagan administration, and so forth, worked to correct from the capitalist perspective, inadequate returns to financial investments and the financial sector. And they did this in a very concerted way and in a way that isn't really recognized in mainstream research, but it's very clear if you look at the documents that that is what they were after. My specific research had to do with the strong dollar. So the value of the dollar has a lot to do with the interest rates that the US private sector experiences, and as well as the flows of capital between the US and the rest of the world. The US, since 1980, has consistently had a trade deficit, and that means capital has also flowed into the US economy, essentially taking surplus from whatever other countries and bringing it into the US financial sector, which gives the US financial sector a larger and larger share of the world's value to manage and turnover and speculate with, used to drive up property values and so forth. To do this, the US had, in the 80s, an extraordinarily strong dollar, which means the dollar was worth a huge amount relative to the other major currencies of the world, the yen, the pound, the mark, and so forth. And that was to the detriment of industry, because the US industry was an export, in part at least, an exporting industry that was producing things for the rest of the world, exporting capital in the physical sense. Meaningful, means of production were going to the rest of the world. And that has been decreasingly the case ever since, because of a very sharp recession that happened early in the 1980s that really had a huge wave of deindustrialization that took over in the US economy. And the manufacturers simply couldn't export over the high value of the dollar. The US goods were too expensive relative to other countries' goods for them to successfully compete. And this created opportunities for a few other countries to do some of the material investment that would have happened had the US capitalists been interested in doing that. What the US capitalists were more interested in doing, rather than continuing with their investment in manufacturing, although of course they do to an extent, there was a little revival toward the 90s, but with those caveats, they were more interested in becoming either multinationals who would purchase assets in other countries, purchase firms, productive resources in other countries that would have a higher rate of profit than what they foresaw from continued investment in the US, or to turn that money over to stockholders or in other ways get into financial speculation and make their profits that way. In a financial market where there is a lot of capital flowing in, where the value of the currency is strong and stable, where many firms are turning over their profits and many households are turning over their savings to purchase assets like houses and so forth, the value of those assets will go up and up and up. And you sort of have a bubble, which can create a higher rate of return based on this demand for the financial assets, which is creating higher values of these assets. That is fictitious capital. It's not an actual surplus. It's not actual wealth that has been created in the world economy. If the price of Tesla stock or Amazon stock goes up to however many hundreds of dollars, and someone that has a book value of their assets, the owner, say Musk or something, of $200 billion, it's not as if $200 billion of wealth has actually landed in his pocket. It's that the assets, which are in the form of stocks, which cannot necessarily be sold, right, add up to that amount. But what this does do is create huge amounts of assets, which banks can then use, again, to create loans and turnover and further accelerate this, inflation of asset prices. And that's what we've seen. We've seen housing and the stock market and all sorts of financial activities create huge bodies of wealth, right, for the capitalists who hold those resources. And since the 80s, the state has gotten involved in making sure this can continue to happen. And I'm speaking here of the US state, but of course it's also true of the other major states of the major financial players. My specific research was that the state has continuously kept the dollar high with a couple things we could talk about, but to the greatest extent of its capability, actions by the Treasury Department. But there's also been the more familiar things like the bailouts of various banks, and later on the cash injections, quantitative easing, and so forth. So in essence, what the US state has done is committed to this kind of political economy of investment concentrated in purely financial areas, and not investment in sort of the normal Marxist sense of development of means of production, but simply money that has been created through lending and banking and loans and so forth. with this snowball effect, right? It's not just, however, that the financial sector has concentrated on these things, but whole areas of the US economy have been geared towards this kind of setup. We have deindustrialization, reduction of the manufacturing sectors, but we have a service economy that is actually much larger. It's larger than it was in the past, certainly, but it's much larger as a share of the overall economy. And in places like New York or San Francisco, the major cities, these services are largely geared to keeping workers and middle classes and even capitalists happy with their kinds of whatever they're doing while they're making profits in the financial sector. And the incomes, moreover, of the middle classes in the United States, their expectations of retirement and so forth, are based on the expectation that this system will continue. This very system and what the US government is doing will continue to accelerate the prices and maintain demand for houses at their extraordinarily high prices, maintain values of stocks and demand for those stocks and so forth. So it will be very difficult for those middle classes or for those capitalists to accept any kind of conversion of the US economy away from these things. And certainly the capitalists in the US are not interested in making large tangible investments in the US economy or really in other places. Now, the US capitalists certainly send some of their surplus abroad in the form of FDI, foreign direct investment, which does occasionally lead to new factories and new production and so forth. But mostly it buys assets in other countries, already developed, things that the US corporations can then take a profit on. Why do they seek to do this? It seems that the rate of return on taking production in a low wage country and then moving the goods produced to higher wage or higher profit parts of the world creates a opportunity for markups, essentially. This is the work of William Milberg at the New School on outsourcing economics. Also, I recommend the work of John Smith, Imperialism in the 21st Century, where the capitalists can find large, sources of profit through exploiting the differences in wages and, in effect, exploiting the capitalist investment of other countries. Because it's not the US firms that make these investments that develop, production of goods in China or many other countries, but it is capital or surpluses that have been accumulated in those countries which themselves build up to allow capitalists in those countries to produce things which then become parts of value chains and surpluses that go back to the United States or to other developed countries. There's analogies to be made with Europe and with Japan and so on and so forth. So most of not to say that most of the economic activity in the US is to do with imported goods or with financial services or other things. A lot of it is the service economy. A lot of it is relatively low productivity, low profit enterprises. Some of them are small businesses and so forth. But the sources of the greatest profit, the most lucrative opportunity for capitalists are to be found in these integrations of the world economy and situations where the US doesn't develop and doesn't invest in a higher level of productive output, but instead relies on financial asset price inflation and so forth to make these great profits. So let's see, how much time do I have, Jay?
You're doing fine, about 4 minutes or so.
Okay. Sorry. So we should look forward to what the consequences of this might be. To refer a little bit to the sort of the theme of the talks today, the state is an organizer of a huge volume of investment from the capitalist standpoint, which is to say money and loans which go to financial markets and participate in this run-up of asset prices. But in the US at least, it is not, generally speaking, at the source of actual investments that are happening in the economy. And it's unclear what would happen if it did try to have, just from an economic standpoint, investments in the economy. Could the US economy actually produce a lot more of anything if a lot of money was put into it. We've seen that when demand has changed in the past year due to the COVID circumstances and the recession, supply chains have been unable to adapt and provide goods that would be used simply by consumer demand, let alone a new round of investment. The US now lacks most of the industrial capacity, such as production of steel and other things, to greatly expand its productive economy as it did after World War II. And that's not entirely a bad thing, because if the US did greatly expand its industrial output and used a lot more energy, that would only further accelerate the climate catastrophe that we are facing. So in addition to that, we might say that there are certain kinds of investment that the US economy ought to be doing, regardless of those issues, specifically, let's say, cleaner energy and things that need to be done to maintain the infrastructure that we have, to try to reduce our carbon footprint and so forth. I think these will be resisted very sharply by the Democrats and the Republicans, the powers of the US government, because they want to see the current political economy continue. They want to see a political economy based on the strength of finance and these capital gains and fictitious capital continue to be the center of the US economy. And they'll run right off the cliff, right? They do not seem to be concerned about what will happen in 20 years. Many of the people who support these policies will, fortunately or not be around in 20 years. And if regardless of what the case is, the capitalists do not have the flexibility to change their form of investment, to change to a new political economy that will not destroy the environment, that will actually, improve the material conditions that we live in, improve our society through useful work, which is not really being done. The work that's being done in the US, to the extent it seems to be useful in developing the country, like building new 4-lane roads in states with 2 senators and 1 representative, and people remodeling perfectly good kitchens so that their house can be worth, $100,000 more when they sell it. Needless work. So the work that seems to be productive that's done in the US economy is in fact destructive, and itself is not investment. It is negative investment in a sense, in the way that it destroys the future conditions that we will live in. It would be better if it weren't done at all. So one last point I'd make is that a lot of people see the Green New Deal as the solution to some of these problems, that there will be better funding the service economy, which generally I would support, and that there will be infrastructure investment and so forth. This will be blocked by a supermajority of the legislature and the presidents and the administrative agencies and the Supreme Court and everything else in the US. It can be foreseen, even if the Social Democrats, which is how I categorize the squad and sort of the left wing of the Democratic Party, somehow were to gain their own own supermajority to try to enact some of this legislation, and they somehow got past the Supreme Court and other things like that, then they would face a capital strike. They would face capital flight from the US. They would face capitalists not cooperating. They would face an economic recession, surely, which we'll see anyway, but one that would be brought on and blamed upon them. They'll be thrown out of office. We can talk on other meetings probably about what steps to take, but these kinds of things can't happen without a much more fundamental transformation of the economic system. And at the very minimum, we have to say that there have to be mass actions that will push capitalists to not immediately stop any good thing that will be happening, and that will include mass strikes and things of that nature in that strategy. So I'll stop there, and thank you all for listening.
Okay, thank you very much, Erik, and we look forward to the book coming